Well, the Securities Trust of Scotland has a global equity income remit, and we have three very clear investment objectives. The first is to provide a very high yield, and that's to our shareholders as a distribution yield. The second is to grow that distribution yield at least in line with inflation every year to protect the spending power of those that are invested in the fund. And the third is to produce capital growth over the long term. Well, it's a very interesting backdrop at the moment. It might be worth just zooming back just over 12 months just to think about the global backdrop. We had a synchronized global recovery ongoing, and markets were doing very nicely, particularly led by sort of higher growth, higher beta stocks and technology stocks. And then we got a bit of a situation during the year where markets tended to decouple and global economic growth has desynchronized, where particularly China has slowed quite markedly. That's had a knock-on effect to Europe, particularly Germany. And also the UK is obviously hanging under the sword of Damocles in terms of Brexit. Last year, I think we went from a period of very strong growth, which meant that corporates were doing very nicely. Corporate earnings growth, particularly in the US, was very strong, which was helped by of course, the tax cuts that the Republican Party put through under Mr. Trump. As we go into 2019, we've just gone through the Q4 last year of a pretty soggy market. And so we believe equity markets actually look quite cheap today and set up quite nicely because actually we think that the fiscal and monetary stimulus that the markets really thought was going to be withdrawn from markets is actually going to be put on to really try and stimulate markets as we go through 2019. So we think we've got a pretty good backdrop. We really particularly like our style of equities in this market as well. Global equity income has lagged wider markets because we've had a tech-led a bull market, and we really believe actually that they should start to do better as we go through this year. So strong dividend growth from the portfolio and hopefully strong capital returns. Well, we think we've got a really differentiated approach to equity income with the Securities Trust of Scotland. Generally, what's interesting is income managers are seen as value investors. That's because they invest in high yield stocks, and high yield is a metric which people use to value stocks, and it's seen when it's higher to be of good value. We actually tend to try and ignore very high yielding companies, and we very much look for companies right across the spectrum for our portfolios that are growing. So we see ourselves not as typical value income investors, but actually as growth investors. On top of that, we undertake what we think are a number of very differentiated processes to make sure that our companies deliver throughout the market cycle, or the economic cycle, if you like. So we undertake extensive scenario planning and stress testing to understand how a company might perform in the bad times, not just the good times, so a recession, if you like. And that's really important for us to understand how the companies will be able to pay the dividend in the future. And some of the answers we get from companies when we run these scenarios are really, really important. So companies will, from time to time, pay the dividend from the balance sheet by putting in more debt, which is actually going to put more risk into the company and may lead to lower returns to shareholders. Of course, they may also stop investing in the company, so divert cash flows to paying the dividend rather than investing for future growth, which won't be good, again, for future returns to shareholders. So these types of things we do in terms of really interrogating the cash flows and the liabilities of the business through the balance sheet is really, really important for us to be able to understand the risk we're taking, and is one of the reasons why I have never cut a dividend from a pooled vehicle that I've managed since I've been doing this, and I now have over 15 years experience of running money in this fashion. So ESG, or environmental, social and governance practices, are really essential part, again, of our investment process. Again, I like to call it an investment system because it's a group of different processes. But we absolutely find that it's fundamental as part of our investment system, really because we absolutely believe that strong ESG practices leads to better performance for shareholders. And there's lots of empirical data out there now to show that that is absolutely the case. We integrate right from the word go, from our first look at a company all the way through to the extensive bottom-up research that we undertake through building a model and therefore on to produce a intrinsic valuation for the companies that we propose to invest into. But we put simply think that it's absolutely going to improve returns to our shareholders. A great example of a stock that we're invested in at the moment is DSM, which is a Dutch vitamin manufacturer, and they have just secured some debt from the debt markets, corporate debt markets, which the coupon is linked to lower carbon emissions targets in the future. So if they hit those targets, it means they pay less interest, which means that they produce more profits, and that will lead to better shareholder performance, and hopefully the stock will do well. So it's simply good for business, and that's exactly why we integrate ESG analysis into our investment system. The great thing about a trust is that we can use lots of different pieces of the toolkit, if you like, and absolutely using derivatives is something that we like to use to be able to bolster the income, if you like, of the portfolio. We generate around about 10% of the income of the trust per annum from options premium, and that's through selling call options and put options, predominantly put options, and they're on stocks that actually come through onto our buy list. So we decide whether to use the volatility and sell options on the stock or buy the stock outright. And as I said, it's really quite a lucrative way of perhaps taking the pressure off some of the other areas of the portfolio where we can actually buy some slightly lower yielding stocks which have faster growth possibilities. So a really nice part of the toolkit that we can use for the Securities Trust. So in terms of performance, we're pretty pleased actually. I think going back to the three objectives that we've got, we've produced a very high yield, and as at the 31st of December, we were carrying basically a trailing 12-month yield of around about 4%. So that compares very favourably with other European markets, but bear in mind this is a global portfolio invested in a lot of lower yielding markets, so we're very pleased with the level of income we're able to produce. Secondly, we've also grown the dividend, and that was announced for the fourth payment of the fiscal year, just after the end of the fiscal year in the early summer, and we grew the dividend by 2.5%, which is in line with UK inflation. And over the last 3 years, we've actually increased the dividend by 24%, which we think is a really good outcome and is way ahead of UK inflation. And thirdly, we produce strong capital growth, and the benchmark that I'm tasked to beat by the board is a composite benchmark of our peer group, which not only is the AIC Global Equity Income Peer Group, but also the open-ended peer group. And we've managed to beat the median of that, which is in line with our target, if you like. So I think we've had a pretty good year. Of course, we're striving hard to do better, and I think the portfolio is nicely positioned, as I say, because I think we're producing strong growth prospects, and particularly we're seeing some very good dividend growth come through the portfolio at the moment.